Welcome to our deep dive on how do firms manage financial risk. It's a pretty crucial topic, especially these days when the financial world feels kind of like a roller coaster.
Yeah, for sure. I mean, everyone's got to navigate these choppy waters, right? From giant corporations down to even like small businesses. Everyone's got financial risks on their plate.
Right. And that's exactly why we're diving into this today to help, everyone listening get a grip on how to think about and manage risk.
Yeah, exactly. And I think a good place to kick things off might be with, well, with a bit of a brain teaser, a kind of counterintuitive question.
Oh, I like where this is going. Hit me with it.
All right, so think about this. Can just a financial transaction like shuffling around debt or issuing some stock actually like fundamentally change what a company is worth?
Hmm. That's a good one. I mean, off the top of my head, you'd think like, yeah, right. Those moves got to impact a company's value somehow.
Well, not so fast. There's this economic theory called the Modigliani-Miller theorem, and it actually says, well, in a perfect world at least, those financial decisions, they don't actually move the needle on a company's overall value.
Whoa, 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 hold up. You're telling me that a company could, like, take on a mountain of debt or issue a gazillion shares and it wouldn't change their value, like, at all?
Yeah, that's the basic idea, but there's a catch, a big one. This whole thing only works in a kind of imaginary world, like a world with zero fees when you buy or sell stuff, no taxes to worry about, and everyone having like perfect information.
Okay, so basically we're talking about a financial utopia that doesn't actually exist.
Pretty much. The real world's way messier than that. I mean, come on, we all know there are always going to be costs and taxes, and, well, let's be real, nobody ever has all the information.
Right. So if we ditch that perfect world scenario and get back to reality where these, like, ideal conditions don't exist, well, does that mean managing risk suddenly becomes, like, super important?
Absolutely. It's like, yeah, in that perfect world, risk management might not matter so much. But in the real world where things are unpredictable and messy, it's crucial. It's what separates the companies that thrive from the ones that, well, don't.
Okay, got it. So let's talk about risk itself for a minute. I mean, are there different types of risk that companies need to be aware of? Or is it all just kind of lumped together?
Oh, no, no, no. There are definitely different flavors of risk. Like, you've got your basic business risk, which is, well, kind of baked into what a company does. Like maybe their product flops or maybe they can't keep up with the competition.
Yeah, that makes sense. Like a fashion company that misses the trend for the season, or a tech company that gets leapfrogged by a competitor with a better product.
Exactly. Then you've got market risk. That's all the stuff that's happening in the bigger picture outside a company's control. Like interest rates going haywire, currency exchange rates doing crazy swings, the whole stock market taking a nosedive.
Oh, right. Like when a company imports a bunch of supplies from, say, Europe, and then boom, the dollar tanks against the euro.
Exactly. And then there's credit risk. That's the risk that, well, that someone who owes you money just doesn't pay up. Like if a company extends credit to customers, they're taking on that risk.
Yeah. And that can be a big deal for companies that rely on getting paid on time.
Totally. And then finally there's operational risk. That's like the catch-all category for stuff that can go wrong inside a company, like internal fraud, or maybe their computer systems get hacked, or even, like a natural disaster that messes up their operations.
Wow. So there's a lot to think about. It sounds like, well, like risk is basically kind of woven into every single part of a company's business.
That's exactly it. And that's why managing it is so important. It's not just about avoiding disaster, it's about making sure a company can survive and thrive in the face of all these, well, these potential curveballs.
Okay, so far we've talked about the different types of risk, but before we dive into like the how of risk management, I think it's worth spending a minute on some of the arguments against it.
Oh, yeah, for sure. There are definitely folks out there who think, maybe risk management is more trouble than it's worth.
All right, so lay it on me.
Right.
Why would a company like actively choose not to manage risk?
Well, one argument you hear is that it can just be a huge distraction. Like you're so busy worrying about what could go wrong that you take your eye off the ball, off what you should be doing to actually run your business.
Yeah, I get that. It's kind of like spending all your energy prepping for a hurricane that might never even hit instead of, actually running your business.
Right. And then there's the whole like data thing. Risk management can be a real data monster. It needs like fancy tools and people who know how to use them, and all that can be, well, super expensive and eat up a ton of time.
So it's not just about having a good feeling about risk. You got to have actual like numbers and analysis to back it up.
Exactly. And then you get the folks who say that trying to manage risk can actually like stifle a company's growth. Like if you're too busy playing it safe, you might miss out on those big juicy opportunities.
It's kind of like that saying, no risk, no reward, right? Like, can being too scared of risk actually hold a company back?
That's a valid point. You got to find that sweet spot between being careful and being well, paralyzed by fear. But I think it's important to remember that like not managing risk, that can be way more costly in the long run.
Right, because if a company isn't ready for those potential risks and something does go wrong, well, it could be game over.
Exactly. So even with all the challenges and the potential downsides, risk management is, well, it's still a vital part of doing business. It's about understanding the trade-offs, and finding that balance between grabbing those opportunities and protecting yourself from potential wipeouts.
Okay, I'm following you. So we've covered the different flavors of risk, and we've talked about why some folks might be hesitant but actually managing it. But now I'm curious to hear what you think are the most compelling reasons for companies to take this seriously.
Okay, yeah, let's dive into that now. I think like the biggest reason is, well, is just how unpredictable the world is. Markets can go haywire, interest rates can spike out of nowhere, currencies can do these like wild dances and all that stuff. It can totally mess with a company's bottom line. If they're not prepared, it's going to hurt.
Yeah, it's like trying to run a business in the middle of an earthquake. You got to be ready for the ground to shift under your feet.
Exactly. And risk management, it's kind of like having those earthquake-proof buildings. It helps companies stay standing when things get shaky. And then there's the whole like financial distress thing. We saw what can happen when companies don't manage risk
Right.
back in '08 or 9 with that whole financial meltdown.
Yeah, that was a rough time. A lot of companies that seemed like totally solid just went under.
Right. It was a huge wake-up call. Made everyone realize that even when things are good, you got to have a plan for when they go bad.
So it's not just about like minimizing losses. It's about making sure the company can actually survive a major hit.
Exactly. Risk management can be like the difference between weathering the storm and going bankrupt. And let's not forget about reputation. Companies that manage risk well, they build trust with investors, lenders, even customers. They're seen as like reliable and responsible, which can be a real advantage in the long run.
That makes sense. If I'm going to invest in a company, I want to know they've got a plan for dealing with problems, not just for, when things are going great.
Right. And speaking of investors, there's this whole other side of risk management that we got to talk about. It's called agency risk.
Right.
It's basically about the potential for conflict between a company's management and its shareholders.
Oh, right, right. You mean like when a CEO makes decisions that like line their own pockets but might not be the best for the company overall or for, the people who actually own the stock.
Yeah, exactly. Risk management can help keep that in check. It's like setting up some guardrails to make sure everyone's working towards the same goals.
Okay, that makes sense. So we've talked about why risk management matters. But how do companies actually do it? It all seems kind of like overwhelming, to be honest.
Well, I think the first thing is understanding the difference between hedging operations and hedging financial positions. Like imagine a company that makes, I don't know, let's say they make furniture. They need a ton of wood, right? But the price of wood can go up and down like crazy.
So to manage that, they could like lock in a price for wood ahead of time. Like maybe they could, I don't know, sign a contract to buy a certain amount at a set price, even if the market price goes up later.
Exactly. That way they know exactly how much they're going to be paying no matter what happens with the price of wood. That's hedging and operational risk. Now, hedging financial positions, that's a bit different. It's more about managing the risk from things like interest rate changes or currency swings. So let's say this furniture company also has a big loan they took out in euros. If the euro suddenly gets weaker against the dollar, well, that loan just got a lot more expensive for them to pay back.
So they could use like a financial instrument to hedge against that risk, like maybe something that locks in a specific exchange rate between the euro and the dollar.
Exactly. That's the idea. They're basically protecting themselves from losing a bunch of money because of those currency fluctuations.
Okay, got it. So there's this whole like toolbox of different strategies and tools that companies can use. But how do they choose which ones are right for them?
It all starts with setting clear objectives. The board of directors, they got to figure out the company's risk appetite, like how much risk are they actually comfortable with, and then they got to decide like How much loss can they handle if things go south?
Yeah, that makes sense. It's kind of like setting your budget before you go on a trip.
Yeah.
You got to know how much you're willing to spend and what you absolutely can't afford to go over.
Right. And then they got to consider, like, who they're actually trying to protect. Are they more worried about the folks who loaned them money, or are they more focused on the shareholders, the people who own stock in the company?
So it's not just about the company itself. It's about like balancing the needs of all the different people who have a stake in it.
Exactly. And they also got to think about like what their goals are. Are they trying to maximize profits right now in the short term, or are they playing the long game, looking for steady growth over time? And are they more focused on the kind of profits that show up on their accounting statements, or are they more interested in the overall economic value they're creating?
So it's like a giant puzzle trying to figure out all these different pieces and how they fit together.
It is. It's definitely complex, but once they've got those objectives figured out, the next step is to like assess the risks themselves. They got to figure out how big each risk is and which parts of the company are most exposed.
So it's like doing a risk inventory. Like
Yeah.
going through and figuring out what all the potential dangers are and how vulnerable they are to each one.
Yeah, that's a good way to put it. And they got to think about the timing too, like when could each of these risks actually hit them? Is it something they need to worry about right now, or is it more of a long-term concern?
Okay, so let's say a company's like gone through all that, they figured out their objectives, they've assessed all their risks. What's next? What are some of the actual tools they can use to manage all this stuff?
Well, there are like a ton of different instruments out there. They could go with exchange traded instruments like futures contracts or options. Those are like the standardized ones. They've got set dates and prices and all that. Or they could go for what are called over the counter derivatives. Those are more like custom made. They're tailored to fit a specific company's needs.
Oh, okay. So it's kind of like buying a suit off the rack versus getting one custom made by a tailor, right?
Yeah, that's a good way to think about it. But there's a trade-off,
Hmm.
Those custom-made derivatives, they come with more risk because they're not like backed by an exchange. It's more like a handshake deal.
Right. So there's more potential for things to go wrong if like one of the parties doesn't hold up their end of the bargain.
Exactly. And companies also got to think about how easy it is to buy and sell these things, the liquidity. And they got to factor in the transaction costs too. Like how much are they going to have to shell out just to make these trades? All that stuff can eat into their profits.
So it's not just about picking the right tool for the job. It's about making sure you can actually use it effectively and afford to use it.
Exactly. And once they've got the tools figured out, then they got to come up with a strategy for using them. And there are like two main approaches: static and dynamic.
Okay, break those down for me. What's the difference?
A static strategy is kind of like setting your GPS and just following the directions no matter what. You put the hedge in place and you just leave it alone until it's time to unwind it.
So it's kind of like buying a house with a fixed rate mortgage.
Right.
You know exactly what your payments are going to be, even if interest rates go up or down.
Yeah, that's a good analogy. Now, a dynamic strategy is more like driving without a GPS, You got to
Okay.
constantly be looking at the map, adjusting your route based on traffic and road closures and all that.
So it's more active, more hands-on. You're
Mhm.
constantly tweaking things as you go.
Exactly. It can be more effective in some situations, but it's also more work. And it can be more expensive too because you're making all these trades along the way. And then there's the time factor. How long does a company want to hedge for? That can have a big impact on their accounting and their taxes.
Oh, right, because how they handle these hedges on their books can affect how much tax they owe, right?
Exactly. And different countries have different rules, and sometimes even different rules for different types of derivatives. It can get pretty messy.
So a company's got to be really careful about how they structure these hedges.
Absolutely. They got to think about the big picture, not just the immediate impact on their bottom line. And then there's the whole question of like, how do you know if your risk management is actually working?
Right, because at the end of the day, it's all about results. Yeah.
Exactly. But here's the thing. Hedging isn't about making money. It's about losing less money.
Oh, okay.
Oh,
So it's like damage control. Like you're not trying to win the game, you're just trying to like survive it.
that's a good way to put it. A successful hedge might still result in a loss, but it should be a smaller loss than if you hadn't hedged at all.
Okay, got it. So It's not about eliminating risk completely. It's about making sure that when something bad happens, it doesn't like totally wipe you out.
Right. It's about protecting yourself,
Mhm.
and it's about being smart about how you do it. Like making sure you're not spending more on transaction costs and taxes than you're actually saving by hedging.
Right. You got to make sure the cure isn't worse than the disease.
Exactly. And companies got to keep reevaluating their strategies too, Make sure they're still working, make sure they're still aligned with their goals. The world's constantly changing, so their risk management has got to change with it.
It's a never-ending process, isn't it?
It is, but it's a crucial one, and I think it's one that more and more companies are starting to take seriously.
Okay, so we've covered a lot of ground here. We talked about like the big picture, why risk management matters. We
Mhm.
talked about the different types of risk, the different tools and strategies that companies can use. We talked uh, about the importance of setting clear objectives,
Mm.
of assessing your risks carefully, and of making sure your hedging actually makes sense.
Yeah, we've pretty much done a deep dive into the whole world of risk management.
We have. So let's take a step back for a minute and try to tie it all together. Like what are the key takeaways here? So we started out like way back at the beginning, asking if financial decisions even matter in this whole like value game. And we kind of went down the rabbit hole with that Modigliani-Miller theory, right?
Yeah, yeah, that whole perfect world thing with no friction and like everyone knowing everything. But we quickly realized that, well, the real world's got a lot more bumps in the road.
Exactly. And those bumps, well, those are the risks we've been talking about. We
Mm.
dug into all the like different types of risk, from the stuff that's baked into a company's business, like their products flopping, to the stuff that's kind of out of their control, like the whole market going haywire.
Right. And we even talked about like the arguments against risk management, the folks who say it can be a distraction or even stifle a company's growth.
But then we flipped the script and we talked about why it's actually crucial to manage risk. Like how it can help companies ride out those market storms and build that trust with investors and, well, everyone who's got a stake in the game.
And we got into the nuts and bolts of it too, right? Like the difference between hedging those operational risks, like the furniture company locking in the price of wood, and hedging those financial positions, like protecting against currency swings.
Yeah, we explored that whole toolbox of risk management stuff from those standardized futures contracts to those more custom-made over-the-counter derivatives. And we talked about how it's not just about picking the right tool, it's about knowing how to use it and being able to afford to use it.
Right. And then there was that whole static versus dynamic strategy thing. Like, is it better to set it and forget it,
Mhm.
or do you need to be constantly adjusting your hedges based on like all the market craziness?
And we can't forget uh, about time, right? Like how long a company hedges for can actually impact their taxes and how they do their accounting. It's all like interconnected.
Absolutely. And at the end of the day, well, it's about making sure that risk management actually works. Uh it's not about making a ton of money. It's about minimizing those losses when things inevitably go wrong.
Right. It's like having insurance, right?
Yeah.
You don't want to have to use it, but you're sure glad you have it when you need it.
That's a great way to put it. So what does all this mean for everyone listening? Why should they care about how companies manage risk?
Well, I think if you're like an investor, understanding how a company handles risk can tell you a lot about them.
Uh-huh.
It's like looking under the hood before you buy a used car.
Yeah.
You want to know what you're getting into?
Yeah, for sure. It can help you like figure out if a company is actually prepared for the unexpected.
Mhm.
Are they are they being smart about managing their risks, or are they just kind of hoping for the best?
Right. And knowing that can make a huge difference when you're making uh, those investment decisions. It's like having that extra piece of the puzzle. It helps you see the the bigger picture more clearly.
Exactly. So whether you're running your own business or investing in the market or just trying to make sense of this whole like crazy financial world, understanding risk management is, well, it's essential. It's like having that superpower that lets you navigate all the uncertainty and come out on top.
I love that risk management superpower. I think that's a perfect way to wrap up this deep dive. So thanks everyone for joining us on this journey into the world of financial risk management. I hope you learned something new and maybe even picked up a few tips for managing your own risks.
It's been a pleasure diving deep with you.